Welcome to our lectures. Today we're going to go through chapter 5 of Financial Accounting Level 1. So chapter 5 is totally different topics than chapter 1 to 4. As we talk about it, chapter 1 to 4, we went through the accounting cycle, right? From analyze a business transaction till closing the trial balance. So that is the 9 steps we have learned about it from chapter 1 to chapter 4. We'll start chapter 5, 6, 7. You're gonna go to learn about merchandising, the inventory, how you're gonna record the journal entries, how to deal with different kind of business transactions. So chapter 5 is the first chapter to talk about merchandising operations. This whole chapter discussed the purchase and the sale of merchandising inventory. And also we're going to talk about how to complete the accounting cycle for a merchandising company. Then chapter 6, we're going to talk about 3 different methods or approaches to deal with the inventory. So when we finish chapter 5 and 6, you're going to have your final exam. Now, first, we're going to talk about is how can we use sales information to evaluate a company. There are some key terms we need to introduce. First of all, products sold, we call it inventory. Okay. Revenues from the sale of the product, we call it sales revenue. We just call sales. Right? There's another terms we say cost of goods sold or cost of sales. It's the major expenses of a merchandising company. Then we're going to learn the gross margin. How are we going to calculate the gross margin? What is the major thing is we use sales revenue, we just talk about it, minus the cost of goods sold equals to gross margin. So those are the different terms and the important key terms we learn before we move on to merchandising operations. One of the things you need to focus is the cost of goods sold. Okay, so that is one of the major expenses, and sometimes students get confused about how to calculate the cost of goods sold. Now, the entity's cost of the goods, which is the inventory, is sold to the customer. While inventories are held, right, it is an asset. When the inventory is sold, its cost become expenses to the seller. Then we're going to talk about a journal entry you need to make. If there's a merchandise to sell this inventory, there are always been 2 different journals to make. One is for the sales, another is for the cost of goods sold. Because it stays in there, the cost of goods sold will become expenses when you sell the inventory. Now we talk about that one is gross margin. We use net sales deduct cost of goods sold. The net sales equals to sales revenue, deduct sales returns analysis, deduct sales discount. So that is the net sales. Okay. Cost of goods sold is the cost of any assets, is the sum of all the costs incurred to bring the assets to its intended use. Now, in the case of inventory, the intended use is to sell the assets. Okay, so the cost incurred to bring the inventory to ready for sale, not the cost of selling the inventory. So what is the cost of selling the inventory? Including the costs such as advertising, sales staff salaries, rentals, offices, right? All those will becomes to another expenses which we say is a operation expenses. So that's different, okay? So pay attention on that. Here is examples to show you what it looks like between a service company and a merchandising company. For service company, the income statements is very easy to see that they're just start with the service revenue and then the expenses and then the income, net income. Okay. But for merchandising companies, we say there's a sales revenue, there's a cost of goods sold. Then you calculate the gross margin. We use sales revenue, deduct the cost of goods sold, we have gross margin. Then all the rest of the expenses belongs to the operating expenses. That is, we just talked about it, the costs for advertising, for a sales staff salaries, those are all operating expenses. So we deduct the operating expenses equals to net income. So that is the difference between service company and merchandising company. Now inventory, turn inventory. Inventory is, right, the business inventory including all goods that the company owns and expects to sell to customer. Now inventory is the assets reported in the current assets section of the balance sheet. What goes into inventory cost? So this is a good example. We have just talked about the cost of the assets, the sum of all the costs incurred to bring the assets to its intended use, right? Net of all discounts. Now, for example, what are the costs incurred to bring a sleeping bag made in Asia to a store shelf in Toronto? The costs which brings the sleeping bag from Asia to Toronto, that is the cost you're going to consider as cost of the assets, right? So first of all, the cost of sleeping bag, right? Everything related to the cost of a sleeping bag. Then we have customs duties, right? Those are paid to the Canadian government. There's the shipping costs. We also call it as a freight end. So you have the shipping from Asia to Canada. Then there's insurance. Right? During the transportation, there's insurance, $1.50 per sleeping bag. So we add up all the costs, $59. That is the total cost of an asset. Okay. Now, then we move on to the operating cycles for a merchandising business. The operating cycle is the length of time that is required for a business to purchase the inventory, sell the inventory, and then connect the cash from the sale so that the cycle can begin again. Okay, so this exhibit from our textbook, it has a better illustrates the operating cycle of a merchandising business. Now, for most retailers, this cycle is less than a year. And we call it current on the current assets because it's less than a year. Because it's less than a year, as the more inventory they can sell, the more money they can make, right? So pay attention, the cycle always starts with cash, which is used to purchase the inventory, right? So then I'll sell the inventory and then collect cash from the customer. We talk about this real operating cycle, the key terms of inventory, and all those different cost of goods sold. Then we move on to two different inventory systems. When we talk about inventory system, there are always been two different inventory systems are used by business. It depends on the business. Okay. First of all is the periodic system here. And the other one is perpetual system. Perpetual system is the one we're going to focus on. Either focus on in chapter 5 and then chapter 6 to do the calculations. So pay attention to the perpetual system. Periodic is easier to understand. The periodic system is used by business that to sell the relatively inexpensive goods. Or they cannot afford a computerized inventory system. So you can see that those are like a cheap stuff, right? Like a big bin of nails in a local hardware store. It's most likely accounted for using the periodic system. Because under the periodic system, inventory is counted periodically. But the level of inventory between inventory counts is not maintained. What that mean? So periodic, for example, when you go shopping, you'll go to Costco, right? You go one store of Costco. And when you arrive at Costco, you're looking for a product A, but you cannot see it. So you go to a cashier and asking for, where do you guys located? Where other locations have product A. So they could search from the internet and they find it out, oh, in another location, we have 3 left. In our current locations, it's all sold out. That is the perpetual inventory system because it keeps a running record of all inventory, right? As it's bought or sold, either with units or price. A periodic inventory does not keep a running record of all goods. If you go to a store who use the periodic inventory system, you're looking for one product and asking if you guys do not have it, if the other store has it, they're not have any record on that. So they will not know. But whatever either inventory system the store use, the inventory counted at least once a year. And so at least once a year. So that is the periodic inventory system, which is talking about it, but pay attention to this formulas to make a calculation. Beginning inventory plus the cost of goods purchased equals to the goods available for sale. And then you use the goods available for sale, deduct ending inventory equals the cost of goods sold. Pay attention. If you see a question, they give you beginning inventory and ending inventory, and they ask you to calculate the goods available for sale, or they give you the cost of goods sold, of course, and then they ask you to do the calculation. This is the formula you're going to use to make the calculation. Okay, so I got a lot of questions regarding how to do the calculation for cost of goods sold under the periodic inventory system. This is the formula you're going to use. Now, where are we now? Yeah, periodic inventory system. Now, we didn't talk about a perpetuity system. Perpetuity system at the same time maintain a running count of the amount of inventory on hand. This system is often combined with a computerized inventory system. The use of computers in business has made this system the most widely used. So as I know, most of the companies actually use the perpetuity inventory system because periodic is just very nice, very less business has been used. Now, when we move on to the chapter objective number 2, how can we track the purchase and sale of inventory when you should know how much inventory you have? Right? We're going to see some examples from here. So perpetuity system, we talked about it before. Remember, it keeps track of every piece of merchandise. Okay. The cycle of a merchandise entity begins with the purchase of inventory. We just remember that the cycles we'll talk about it. Started with cash to purchase inventory and then sales to the customer and then collect the cash, right? Now, we have a journal entry to record a purchase of 700 of inventory on account. With debit inventory, credit account payable, right? That's its purchase inventory on account. Now, the examples we're using is from the Slope Ski Shop. That is the buyer. So the buyer issue a purchase order, which is a PO, to the Lage Sportswear, the seller for merchandise they wish to purchase. It's always start with the purchase order. The Lage will issue an invoice or bill to Snopes for the merchandise it ships by asking for money because they're seller. Now the invoice, we have examples in our textbook to show you what the invoice looks like. The invoice has a seller's name, the invoice date, the purchaser's name, the address, billing and shipping, credit terms, available discount. We're going to talk about available discount later. Items ordered and corresponding pieces, right? So there's also, of course, the invoice total. That is the invoice. We're not going to have examples in our slides, but we should have it in our textbook. There are two major types of discount. Quantity discount or purchase discount. Quantity discount, easy to understand. They offer for a bulk purchases that's not recorded in the account. So the purchase is recorded at the list price as well as the quantity discount. Now, a invoice contains terms, right, of payment that may include a purchase discount and the date by which the invoice must be paid. So normally we see like 2-10 or N-30. Well, that means the items indicate 2% discount if the bill is paid within 10 days. of the invoice date, of course, or you have to pay the full bill, is due within 30 days. If you pay after 30 days, you get penalty on that. Most of the company has the penalty and also the term. So that what is the term mean? Now we see examples. Snopes purchased from Lage inventory on May 27th. 700 on credit was turned 2 out of 15 and out of 30, which means if you pay within 15 days, you have 2% discount. And the full bills should be paid within 30 days from May the 27th. Now the journal entry, we already talked about that, right? This is a purchase on account. So we debit inventory, credit, account payable. Now, June 10th, that within the 15 days, right? The Snopes pays the invoice on June 10th. Now this is within the discount, so we have 2% discount. The accounts payable has no change. We have to debit accounts payable. Now we have to pay this full liability off. So we credit, cash, and inventory. We use inventory to say this is a discount. So you can just simply put inventory discount, but this is represent a discount. So our inventory will be 2 times 700, 2% times 700, which is $14. And the total cash we paid off the 700 bill will be $686. That is how you're going to record it under a journal entry. Now, when you finish the journal entry, you can put into a T account. You see the inventory T account. We have purchase inventory increase 700, which is the debit, right? Debit side. And then there's a discount $14, which means the balance of the inventory will be $686. So that is how affected the inventory account. If the Snopes pays the invoice on June 25th, which is past the discount date, 15 days, right? Before the due date, which is 30 days. So we just simply record it as debit, accounts payable, credit, cash. So the resulting of the inventory has no change, right? It keeps $700. Purchase return. Purchase returned and allowance. Merchandise returned to the seller and allowance is granted to the purchasers for damaged goods. It decreased the liability and also decreased the cost of inventory. Now we see a journal entries together. Now we purchased, Snopes purchased from the Lage on May the 27th. June 3rd, Snopes returns 450 of inventory to Lage. Right? We're going to record it for the inventory return. That means from the Snopes side, this is Snopes. Inventory decreased 450. Accounts payable decreased 450. So the total money that has to pay to Lage decreased $450 because we returned, the Snopes returned those inventory. Okay. So this is the return of inventory journal entry looks like. Then the next day, Snopes determined that one of the items slightly damaged, but is willing to keep it, right? Exchange for $25 allowances. The $25 allowance will be paid by Lage. That means the accounts payable will decrease $25 because we're going to receive that $25 allowances. Our inventory will be recorded for purchase allowances would decrease $25 because it's going to decrease our total inventory values and also decrease our total accounts payable. Okay, so that is how you recorded a journal entry for a purchase allowance. Okay, this is for a purchase return. Pay attention to those two journals because you're going to see it in your final exam. Now, when you finish the journal entries for purchase return allowances, you will see how are going to affect in the T account. So under T account, we have our inventory accounts and accounts payable account. For inventory, May 27th, purchase 700 inventory, then returned 450, and then received $25 allowance from the age. Okay, the balance of the inventory will be 225. In the same thing, because accounts payable should be equal to our inventory. We have our May 27, 700, which is on the credit side because it's liability. Liability increase under credit side in the T account as on the right side. Okay. Then return 450, which is decrease our accountability. So on the left side, and then decrease accountability $25 because its allowances have been received from the seller. Our balance leaves for accounts payable will be 225, which equals to the balance of the inventory. That is the how it affect each other. Now, next one we talk about transportation costs. That is means who's gonna pay the shipping. Okay. The purchase agreement specified FOB, which free on board to indicate who pays the shipping charges on purchased merchandise. We have examples in our textbook. I summarize this term. There's FOB shipping point and FOB destination. FOB shipping points indicates that the buyer bears the shipping costs. So the title passes to the buyer upon the shipment of the goods. So whenever the goods leave the seller's storage house, then the buyer owns the good. Then this method is more common used than the FOB destination. FOB destination means that the seller bears the shipping costs because the title passed to the buyer upon receipt of the goods. So even though the goods leave the storage of the buyer still owns. Okay, so the buyer gonna pay the shipping costs. The seller pays the shipping costs. Whenever this goods arrived buyer's storage, the legal title is passed to buyer, so buyer gonna own. How are we gonna record the freight charge? On June the 1st, Slopes received 100 shipping bill from the freight company because the shipping points, right? That means the buyer bears the shipping costs. So the buyer gonna pay. Buyer is the Slopes, right? Lage is the seller. So June 1st, Slopes received $100 shipping bill from the freight company. Now we need to record these costs with debit, inventory, 100, credit, cash. Okay. Did you find out that everything just recorded under inventory, right? No matter if there is a inventory returns, inventory allowance, then there is a transportation costs, it's all we recorded under inventory. So when we take a look at the inventory T account, we have this $100 deducted on the debit side, so which is on the left. We recorded the balance will be $325. Okay, that is how you record the transportation costs. Now, summary of inventory costs. The inventory costs will use purchase of inventory, deduct the purchase return allowances, deduct the purchase discounts, and plus the freight in, which is equals the total of inventory costs of $60,000. You should see this T account in your textbook, have a detailed analysis of what this number is coming from. Now, selling, the next one, we'll talk the sales of inventory, which is the next step in the operating cycle. And it can be for cash or on account. Okay. So the sales of inventory, so maybe for cash or on account. It also requires a cost in the form of expenses, cost of goods sold. So that is the only thing we can see that the merchandiser has changed the role from the purchaser to seller because the first inventory cycle completed, right? That is use the cash to purchase the inventory. That cycle is down. Now we move on to the selling inventory cycle. Experience what sales return is very similar to the purchase. sales return, sales allowance, sales discount, fried out. Snopes will have to pay delivery expenses to transfer the goods to the buyer's location. Okay. That is FOB, shipping point. So we're gonna see a cash sales example. Snopes has $60,000 of inventory on hand. On July the 9th, and Snopes has cash sale of $10,000. Cost of goods sold is $6,000. Journal entry to record the sales and to update inventory. Now remember that as long as it's related to an inventory sales, we have to have two journal entries. First of all, we record the sale. We debit cash, $10,000, credit sales revenue, $10,000. Then the second journals, we have to record it, the cost of goods sold, because the cost of goods sold becomes expenses, right? So we debit cost of goods sold, credit inventory. And when you take a look at the T account, that is how it looks like. The inventory, we have $6,000 because it decreased, we sold it, right? And then our balance will be $60,000. And cost of goods sold is $6,000 on the left side. Sales on account, so it's not for cash, now it is for credit. On July the 10th, Snopes Ski Shop sells $24,000 on account to High Hope Ski Chalet. The cost of goods sold is $14,400. The interest to record a sale to update the inventories. A very similar, just instead of the cash is account receivable. So with that account receivable credit sales revenue. Okay. Then at the same time, we have to record the cost of goods sold because cost of goods become expenses. So we debit cost of goods sold, credit inventory. Then when the cash is received on July 31st, we simply debit cash, right? Credit account receivable. This is no sales return or no any allowances happened. That is how you record it under inventory sale. Now we move on to talk about the sales discount or sales return allowances. Sales discount is a cash incentive granted to the customer to encourage prompt payment. It's very much the same thing as a purchase discount, but from the seller's perspective, right? Now, the sellers offer the discount. Sales discount are recorded in the contra revenue account. We call sales discount. Okay, so whenever there's a sales returns or sales discount happened, not return sales discount happened, we use sales discount. For sales return analysis, we use a sales return analysis. So those are two different accounts we have to keep in mind. We have talked about this is how you calculate your net sales. We use sales revenue, deduct discount and return analysis, right? We'll see examples together. On July 12th, High Hopes returned goods to Snopes for $3,000. Now the returned goods has a cost of Snopes of $1,800. Now Snopes will have to issue a credit memo and then journalize the interest for this sales return. So we debit sales return analysis, credit accounts receivable. This is under seller's perspective, right? So that means our account receivable would decrease. And then because of sales return analysis increase for $3,000. So we debit sales return analysis and credit account receivable. And same thing, when there is a sales return, we have to record a cost of goods sold. Okay, so we debit inventory, credit, cost of goods sold. So memorize those journals. You're going to use it in your final exam. Assuming on July 15th, Snopes granted a 500 allowances for damaged goods. Now the seller, the Snopes record the following journals. The 500 allowances, which is the one decrease our account receivable. So we debit sales return allowances, credit accounts receivable. Okay, very similar to the sales return. Note that there is no entry required for inventory since the goods were not returned. So we do not need to record the cost of goods sold, just for a sales allowance. Then we update account receivable balance. At the very beginning, the balance have $24,000. Then we have $3,000 return. We have $500 allowances, which leaves account receivable for the High Hope Ski Chalet is $20,500. So that is our balance under account receivable High Hope Ski Chalet. July 24th, keep going. High Hope takes advantage of the turn 2 out of 15 and out of 30. Remember that $20,090, $20,500. I mean, that is the balance, right? So we have our total account receivable $20,500, but then there is a 2% discount. We use the 2,500 times 2%, which is the total discount will be 410. Then as the High Hope company, no, not High Hope Slopes, as the Slopes company, the total cash we received from our customer High Hopes is $20,090. So to record a journal entry, we debit cash, which is we received, and then the sales discount. Then we credit accounts receivable, $20,500 discount. Then the remaining balance of $5,000 is connected, simply just debit cash and credit account receivable. So that is the full example to show you how are you going to do the journal entries for the full inventory cycle from the cash purchase inventory as the purchaser. After finish that cycle of purchase the inventory, then we move on to purchaser from a seller, right? So we deal with the customer to sell the inventory, either by cash or on account. That is the full cycle when you need to record under inventory sales. Now we move on to the next topic to talk about how can we adjust for possible inventory shrinkage and begin the next cycle using the perpetual inventory system. How are we going to deal with the inventory shrinkage? Why there is an inventory shrinkage? There is sometimes is a damage, right? The difference between the count on the hand and the inventory recorded on the accounting book, that is the shrinkage. See the examples in here. Inventory balance before adjustment is $174,000. And then the staff has counted the inventory in the storage room and found out they're only $168,000. So there is a shrinkage of $6,000. Then we need to make adjustment for the inventory shrinkage, right? So we debit cost of goods sold, credit inventory. So that is how we record inventory shrinkage. That is the journal entry looks like. Closing the account of a merchandising business. The closing entries in this chapters are prepared as in chapter 4. If you still remember how to closing your account in chapter 4, the only difference is with the addition of some new temporary account. First of all, is a purchase discount, purchase return allowance, and cost of goods sold. So those are the temporary account. Remember, you're only gonna close the temporary account, okay? Not permanent account. So for merchandising business, there's only sales discount, sales return allowances, and then the cost of goods sold you need to close. Now, similar to the closing account we have there from chapter 4, we debit revenue accounts, credit income summary, credit expenses account, debit income summary, and then we credit sales discount, sales return allowances, debit income summary, and then credit cost of goods sold, debit income summary. Because we're treating the cost of goods sold as a expenses account. So it's very similar to expenses account, which is simply debit to income summary. Okay. Then after we finish all the temporary account, we close the income summary, then credit to capital. Then the last we close the withdrawals. Right, with debit capital and credit withdrawal. So this is the journal entry looks like when you need to close the account under merchandise business. This is a T account. When you closing the temporary account, we can see that the withdrawal balance will become to 0. The income summary should become to 0. Then the capital has to be changed because we close income summary and withdraw into capital. Now, next one, we need to, how are we going to prepare a financial statement for a business? We're using the perpetual inventory system. We're going to talk about the 3 different financial statements: income statements, owner's equity, and balance sheets. Now, income statements for a merchandising company shows classification of income statements account in the order of net sales, cost of goods sold, gross margin, operating expenses, and the income from operations, right? And after the income from operations, we listed the other revenue expenses. Now pay attention to other revenue expenses. Other revenue expenses are revenue and expenses outside the main operations of the business. For example, there are interest expenses or interest revenue, gain or loss on the sale of assets. A good examples can be talk about what is the main operations for a business. For example, McDonald's, the main business operations, main operations, selling burgers and fries, right? It's not saying McDonald's selling buildings. It's not an estate company. However, if during the year, the McDonald's decides to sell a few restaurants buildings that is no longer using, then the gain or loss from that transactions will be classified as other revenue expenses. So that is how you define the main operations or outside the main operations. Okay. So there are 2 basic format of income statements. We see multi-steps or single step. We could have quick take a look at it. So this is the multi-step of income statements. It's just the format different, right? We have our sales revenue. We less the sales discount, have a net sales revenue, and we calculate our cost of goods sold. We have a gross margin. The gross margin deduct operating expenses, have income from operations, and then there's other revenue expenses to make the calculation equals to net income. So that is the multi-steps. Now, single steps is it's kind of easier because it just simply put all the revenues together, all the expenses together, and simply calculate the net income. Okay. So the advantage of a single step format is that it groups all revenues together and deduct all expenses together. It's very popular with service company because there's no such difficult for cost of goods sold or calculate gross margin. So it's very popular with service companies. When you compare those 2 different formats, you can easily to find it out that the multi-step is more informative, right? It has important subtotals called a gross margin. We're gonna show a visual analysis because gross margin is one of the major points that when you analyze a business to see the business of financial situations. Now, the statement of owner's equity. The statement of owner's equity is exactly the same in chapter 4, so there's no change. We start with earning beginning balance of the capital, add any net income or deduct any net loss, and then last the withdrawals or plus the investment, right? Have a ending balance of the capital. So exactly the same between service company or merchandise company. Balance sheet. The balance sheet is similar to the one in chapter 4, except there's additional inventory under current assets. Right here. So there's a inventory under current assets. So the rest of the parts is the same. Then how can we use ratios to evaluate business? Now that is the one which I just talked about it. One of the major things is the gross margin percentage. How are we going to do the calculation? What it used for to analyze the business, right? So the gross margin percentage ratio expresses the relationship of entity's gross margin to its sales. The gross margin percentage is very important to retail business. So you can see from this example 5-13, which is coming from our textbook, it compares the Slope Skill Shop with Canadian Tire. I remember before it was with a Walmart though. Anyway, it's very similar between the Walmart and Canadian Tire. The lower the gross margin percentage, the more volume of sales a business needs to be profitable. Right? Think about that way. Discount store like Walmart or Canadian Tires, they need to sell a high volume of goods to be profitable. But we take like Slope Ski shops, right? Because the gross margin is high, so they do not need to sell that much as Canadian Tire. So that is how the gross margin percentage is important that you need to keep in mind. Okay, so the calculations we use gross margin divide net sales revenue. So this is the number for Slope Skill Shop. Okay. Yeah, so that is for Skill Shop. The 43.9% gross margin, which means each dollar of sales generates almost 44 cents of gross profit. It's pretty high. And when you compare the Canadian Tire, which means $1 sales generate 35 cents of gross profit. So that is very different. Now, when we talk about this, is very to measure a profitability for the business, or even just for a product line. If you get a chance to learn the management accounting, you will find it out. There's a lot of management decisions you need to make regarding the cost of a business, or the line, the product line. We just keep one line, we just deduct another one. So those are the different things. The next percentage or the ratios we're going to talk about is inventory turnover. Inventory turnover indicates how rapidly inventory is being sold. Sooner the better, right? So we have the calculations. The inventory turnover equals the cost of goods sold divided by average inventory. Pay attention to this calculation. It is the average inventory. I got a lot of students who made this simple wrong. They use ending balance of inventory. You have to use beginning inventory balance plus the ending inventory balance and divide by 2. Okay, so this is for slopes 2.6 times per year. What that mean? We use 365 days, divide by 2.62 times, equals to 140 days. So that means the slopes needs 140 days to quickly sell their inventory. So that is the average days. A higher rate of turnover is preferable, because the higher of this inventory turnover rate, the lower of the date. Okay, so if this is like 50 times, then they're much lesser than 140 days to sell the inventory. So that's why. Now the overall, the two different ratio analysis, we're not simply just use only those two ratios, right? So only one or two ratios is not enough, provide enough information to do a fully analysis of a business financial situation. However, these ratios do give examples or how accounting information is used to manage a business. So ratio analysis is one of the most important tools to do business analysis. Now for inventory turnover, the rate of inventory turnover for grocery store is very quick, while the rate for furniture store is a lot slower. Yeah, so that makes sense, because grocery store, the high volumes, the much quicker than the cars or furnitures, right? Now, when we do how IFRS affects companies that sells inventory. Now, under the asset, which is ESPE, revenue is recognized when the requirements as to performance are satisfied. But for IFRS, there are 5 different parts to recognition. They're basically the same to realize the revenues, but IFRS give more different, like, detailed analysis of the situations to recognize the revenue. So that is for chapter 5. Have a basic introduction of the merchandising inventory. Then for chapter 6, we are going to talk about different method or approaches to how to do the calculation for different inventory and how are we doing it. Any questions? No questions? Good. Okay, so if there's no questions, I'm gonna, okay, perfect, thank you. So I'm gonna stop the recording now.